Welcome back, everyone. In this video, we're going to be discussing scams. And I know, not the funnest topic, but one that I think is important. When we think of scams, at least in my case, when I think of a scam, I think of people calling from India, pretending to be Amazon customer support. Or I think of people sending phishing emails, trying to pretend to be your bank and getting your login information. Or there's people that impersonate me on Twitter and Instagram. There's people that pretend to be me to try to get your information. At the end of the day, scams take all various forms and shapes and forms of trickery, but at the end of the day, what they're really trying to do is separate you from your money in a very dishonest way. That is the heart of a scam. It's in dishonesty, it's in trickery, it's in separating you from your money. The problem is, while most of us are aware of all these various scams of phishing emails and phone calls and bots online, there's a whole other set of scams that exists right in the equity markets, with the stocks that we deal with every single day. Many of them are companies that we already know about. They're companies with very nice logos. They look nice on the outside, but for lack of a better term, they're basically functioning as a scam. Now remember that a key ingredient of a scam is dishonesty. It's trickery. There's lots of companies in the stock market that are frankly just bad companies, but they're not necessarily dishonest. I'd give an example of that being MoviePass. This company's business model, for lack of a better word, was simply taking money from investors and giving it to customers, taking more money from investors and handing it right over to customers. They did that in the form of a subscription movie service that allowed you to see unlimited amounts of movies for $10 per month. And since almost every customer saw more than $10 worth of movies, the company lost money. The more customers they gained, the more money they lost. And eventually, surprise, surprise, this company went bankrupt. But was this company a scam? Well, I don't really think it was that dishonest. It was clearly visible what this company was doing since the beginning. In fact, even the executives of the company said, we're losing a lot of money. We're not profitable right now. So if you're investing in our company, you're investing in a very unprofitable business. They said that numerous times. So even though MoviePass was a bad company, destined to fail, I don't really consider it a scam because it lacked that key ingredient of trickery. But this is where things get more complicated. Outside of MoviePass, there's many companies in the market right now that are still money-losing companies. They lose money every single quarter. They lose it every single year. They lose money ever since they were created. They're unprofitable, money-losing businesses. But unlike MoviePass, they use tricks and gimmicks to try to make them look more profitable than they actually are. And to most naive investors, retail investors, it's very difficult to figure out how unprofitable they really are. And at the heart of this trick, at the heart of this difficulty in figuring out how profitable they really are, is this right here, stock-based compensation. When most of you hear this, you probably view it as a positive thing. In fact, many of you are probably earning a part of your compensation as stock compensation. Simply put, stock-based compensation is paying an employee in part shares. You give them shares of the company instead of paying them in cash. Now, this does have a positive benefit. There's some stated upside to stock-based compensation. It is typically used to motivate employees beyond their regular cash-based compensation and to align their interests with those of the company's shareholders. So the idea behind this, the argument for stock-based compensation, is that it's simply a way to make it so the employees of the company are aligned with the shareholders. We're both owning shares of the company, and that's why companies should pay in stock-based compensation. Well, if you actually look at that, you could do the exact same thing with cash. In terms of giving extra incentive to employees, you could give extra cash to employees. That's extra incentive. Most employees, for example, would love having their salary doubled. And in terms of aligning the interests of the employees with the company's shareholders, you could likewise do the same thing in cash, giving them bonuses when they meet certain metrics, when they get certain long-term goals. So if more cash could accomplish the same thing as stock-based compensation, why is it that so many companies prefer to pay a large part of an employee's compensation in stock? Why do they have this preference? Well, let me offer an alternative idea, one that most companies won't openly state. When a company pays their employees in stock instead of cash, it does not show up as a cash outflow. It doesn't show up as a cash expense. And therefore, it can give the impression that the company is more profitable on a cash basis than they actually are. Another way of putting this is that it misleads a lot of investors. It makes companies that aren't really profitable look and appear profitable. That is trickery, and this is becoming a very big problem in the stock market today. Now, let me go ahead and give an example of how big this problem actually is. It's very difficult to tell at first glance how big of an issue this whole stock-based compensation and cash flow thing actually is. And if you're not an accountant, you'll probably find all of this very complicated. But let me try to break it down very simply using Qualtrim. This tool is one that I created. It's available to all Patreon members. Now, what I'm going to do is go through a couple different companies here to try to illustrate the gravity of the situation here and how it might affect your holdings. For example, we have Home Depot. Home Depot is a real profitable company with good corporate governance that's had incredible returns over the past 10 years. We can look at the cash flows of the company, and this is something that every investor will say to do. Look at the free cash flow of the company. The free cash flow is the cash flows from operations subtracting the CapEx. That's the cash left over. Now, we look at this line right here, and this shows us the free cash flow by year. You'll notice the trend. It's very positive. Home Depot has real cash flows growing year over year. But what we can also look at is stock-based compensation. We have to pay the employees, and again, the stock-based compensation doesn't factor in to the cash flows. It's not factored into this calculation because it's not cash. Now, I added in a new toggle here, a new option in the middle that shows the stock-based compensation. Let me zoom in here so you can actually see it. The stock-based compensation is this purple bar here, and I put it right next to the free cash flow. What you can visibly see at a glance without even looking at the numbers is that Home Depot generates a lot more free cash flow than they pay their employees and their executives in stock. In fact, in 2021, they generated $16.38 billion in free cash flow, and then they only paid in stock $300 million. So they generated $16 billion, that's total free cash flows, paid $300 million in stock. The majority of the money is just money for the investors. Money left over at the end of the day for you and me. What can Home Depot do with all of this money? Home Depot can return that money to the shareholder. That's where you get profits from this stock. For example, they return it in the form of a growing dividend. And Home Depot has grown their dividend for the past 10 years at 20% per year. That is incredibly fast growth. They're paying you out a dividend, real money in cash every single quarter. They're also doing share buybacks, reducing the amount of shares outstanding. And again, Home Depot can do this because they're generating a lot of free cash flow and their stock-based compensation. This expense of paying employees with your stock is really not that expensive. See, the benefit of investing in a company like Home Depot is most of their employees are simply hourly workers. They're not able to demand stock-based compensation and big compensation packages. Where you run into trouble of employees demanding high amounts of stock-based compensation is more specifically in the tech industry. Let's take a look at a couple companies here. We can plug in Adobe as an example. This is a great company that is likewise growing its free cash flow like crazy. We've seen this graph many times. Their cash flow has gone up tremendously over the past 5 years. But when we factor in stock-based compensation for this company, you can see that it's a bit different than Home Depot. Adobe employees are software engineers, they're graphic artists, they're project managers. They're employees that demand higher compensation because they have more training. Now, when we look at this, last year, Adobe did $6.8 billion in free cash flow, and they had to pay out $1 billion in stock-based compensation. $1 billion compared to Home Depot's $300 million. And they did less in free cash flow than Home Depot. So they have less free cash flow, higher obligations of paying their employee in stock. And if you're just looking at the free cash flow statement, you're not going to see that added effect of stock-based compensation. But in reality, this is a real expense for the company. Another way of putting this is if Adobe had to pay their employees in cash instead of stock, they would have only $5.8 billion of free cash flow, not $6.8 billion. That's the way of looking at it. This amount of cash flows is not going to the investors, it's going to the employees. But overall, even so, Adobe's not too bad. We can start looking at other companies where the problem gets even more concerning. We can take a look at Salesforce here. Salesforce has a lot of growing free cash flow, like a lot of these companies. If you're looking at the cash in, cash out statement, this is what it looks like. Free cash flows have grown dramatically over the past 5 years. When we add in stock-based compensation, it starts to paint a different and more concerning picture. At a quick glance, you can easily see that the amount of stock that this company is paying employees actually eats up half of the free cash flow. For example, in 2021, they generated $4.09 billion in free cash flow, and they paid their employees $2.19. half of the free cash flow was eaten up by stock-based compensation. If they paid those employees in cash rather than stock, they'd only have $2 billion of free cash flow. Now, I own both Adobe and Salesforce. I think they're good companies, but I have to admit, I have to concede that this is a little bit tricky. This whole thing of showing cash flows and how profitable the company is without factoring in stock-based compensation is highly misleading. With companies like Salesforce, once you factor in stock-based compensation, what the employees are actually taking, the company's half as profitable as previously thought. That's a pretty substantial difference. And in terms of how bad this problem is, Adobe and Salesforce are not the worst. There are companies in the market that I think have much worse problem with this, and investors don't realize it. Let me go ahead and give you a couple examples of it. We look at Palantir here. This company is very popular amongst social media. There's many people invested in it. We can look at the free cash flow of the company. I'm sure you've seen this chart and you've heard the words over and over again that Palantir is profitable. Look at the cash flows they're generating in. It's true if you look at just the cash flows, but remember, if you factor in the non-cash expense of stock, you actually have a company that's never generated a profit. They've only had one quarter throughout their entire history that they've ever posted a profit. One single quarter. Almost every quarter, they're posting consistently less free cash flows than their total stock-based compensation. If they had to pay their employees all cash instead of stock, this company would not be generating a dime in profits. Now, it may sometime in the future, it may sometime down the road, who knows what the future holds, and maybe all the claims of this company being great will be true, but as of right now, this is the real picture. This company has a problem with paying employees far more than the investors are getting. And what do investors really get out of a company like this? When a company can't post any real profits beyond their expenses of paying employees, they can't pay a dividend. This isn't like Home Depot, where they can pay a growing dividend that grows 20% per year. Paying a dividend requires actual cash flows. That's part of the reason I love dividend investing, is those companies actually have to make real money to pay you, the shareholder. But a company like Palantir can't afford it. They have no real free cash flow. The company's not going to be doing buybacks. Quite the opposite, they have to do dilution to pay all of their employees' salaries. Investors have never made a dime on it. It's down 62% year to date. All time, this company is down 26%. Since IPO, no investor has made any money on it. In fact, most investors bought it at a substantial high and are heavily in the red on this company. So who stands to benefit from a company like this? The investors certainly haven't. They're the ones providing all the capital, providing all the liquidity. The person that's taking all of that liquidity are the insiders. Alex Karp, the CEO of Palantir, got a pay package worth $1.1 billion. This is money from the investors. You can actually see this show up as a quarterly stock-based compensation payment, $849 million taken from investors given to the CEO. Who else stands to benefit? Well, we have software developers making $192,000 a year, $158,000 a year, $192.9, and so on and so forth. The employees are making money. The executives making money, but the investors aren't making a lot of money. Quite the opposite, they're the ones holding the bag. Now again, this could change in the future, maybe it will, but the relationship right now is pretty clear. The executives and the employees are benefiting, the shareholders are not. And there's a lot more companies like this. I can give the example of Snapchat. This company's one that's only lost money ever since it really IPO'd. We can look way back in 2016, it had free cash flows going out. More free cash flows going out, more free cash flows going out. It recently had some positive free cash flow, especially in 2021, so there's some hope here. But if we factor in stock-based compensation, it makes the picture look slightly worse. We can see huge pay packages for the executives there. They got their bonus, believe me, they got paid well. Then we can see every single quarter as a company's losing money, the executives, insiders, and employees of the company are getting paid. They're getting their payment. But the investors, not so much. The investors see cash going out. They're not getting a dividend because the company can't pay a dividend. They have no real money, remember. The company is diluting shareholders to an incredible extent, doubling the share count over the past 3 years. And then worst of all, the returns have not been great. It's down 79% year to date. If we zoom out to all time, it's down 59%. This company has literally only lost money for investors, unless you're one of the ones lucky enough to time the volatility. But since its IPO in 2017, no investor has made a dime holding Snapchat. Who stands to benefit in this relationship? Which party is making money? Evan Spiegel's getting paid, the CEO of Snapchat. $2.5 billion net worth from selling shares. So think about this relationship for a bit. The CEO of the company has billions of dollars in a mansion house. What do investors get out of investing in Snapchat since IPO? Minus 59%. There's winners and losers in this relationship, and I think it's very clear to see which party's winning. Now again, Snapchat isn't the only example of this. In fact, it's not the worst example. We could look at a lot of other companies. We have Twilio here. This is a great product. A lot of developers use it, but the company always loses money. Every single year, it has cash outflows, money losing. Then you factor in stock-based compensation, and you can see the dramatic rise in the amount that the employees and executives are being paid. So investors are funding this company, taking on huge losses while the insiders, executives are getting paid handsomely. We look at Jeff Lawson here, the CEO of the company, worth $370 million. We can look at the amount of times that he's cashed out and been paid. It's basically every single quarter. We have month after month after month selling millions of dollars worth of stock. The money comes in from investors and it goes out to executives and employees. This is a growing problem in 2022, and I see it only getting worse, but this actually is not a new problem. This has existed for a very long period of time. In fact, it's existed for decades. Now, one person that wrote about this same problem long ago was Michael Burry. Back in April 3rd of 2001, Michael Burry published a letter to his investors of the Scion Value Fund. In this letter, he gives an update of what's going on. And think back during this time, 2001, 1 year after the dot-com bubble started to burst. Stocks were falling like crazy, and it seems very similar, very, very strikingly similar to the situation we're in right now. It's 1 year after the initial dot-com bubble burst. They were still coming down in price. There's one section of this that I want to skip to that I think is very applicable to current day. It's titled Where Value Isn't. Following is an outline of the problem that a lot of technology-related companies face and that makes their stocks in general overvalued. Unlike nearly every other industry, technology companies, as they're generally grouped these days, compensate their employees in a manner that hides much of the expense of the compensation from the income statement. Of course, the subject here is options compensation. That is another way of saying stock-based compensation. Now, Burry goes on to address the claims that stock-based compensation is great for the company and the tax benefits that it has. He says in a rising market, the net income tax benefit can be quite large, but it only reflects roughly 35% of the actual cost of paying employees with options. How does it cost the company? Because the company must either issue new stock at a severe discount to prevailing market prices or buy back stock at prevailing market prices in order to provide stock at a discount for employees exercising their options. The cost is borne by the shareholders, who suffer from significant dilution. The per-share numbers worsen, while the absolute numbers improve. After all, issuing stock at any price is a positive event for cash flow, if not the shareholders. That's a pretty big rebuke of stock-based compensation from Burry, but this only gets worse. Many and probably most technology companies are therefore private companies in the public domain, existing for themselves, not for the shareholder owners. He literally calls these companies private companies that are existing only for themselves. They're selfish. They only want to reward themselves and not the shareholders. Of course, it is a shell game. A prolonged depressed stock price, for whatever reason, including a bear market, would cause a lot of options to become worthless and would likely require the company to either start paying more in salary or worse, start repricing the options at lower prices. This is exactly what a lot of companies are doing right now as the stock price falls. He continues on with this rebuke, saying, in truth, this type of activity might be expected from companies that were often created with the help of venture capitalists who view the public shareholder as an exit strategy, not as a group that deserves to benefit from the improving company results and prospects. The significant implication here is that shareholders cannot count on these sorts of companies for proper corporate governance. They have demonstrated that they'll ask the shareholders to bear the burden during the good times, and they'll reprice the options during the bad times, thereby taking from shareholders both on the way up and on the way down. This is a striking rebuke from Michael Burry to the tech companies at that time. He says that many of them view the public shareholders as an exit strategy, liquidity. He says that these companies exist for themselves, not for their shareholder owners. And they don't view shareholder owners as someone that should benefit from the company's fundamentals improving. He also concludes with this, saying the eventual outcome of companies that operate in this way. The significant implications for the valuation of many popular stocks in a coldly calculating market rather than a speculative one is the stocks of companies governed with such little respect for shareholders will suffer. The companies that do not care about shareholders will eventually suffer. And there are many companies that are being punished because they clearly only existed for themselves. I think what Michael Burry wrote, even though it was written 21 years ago, is more applicable today than it was ever before. The companies that exist in the market today, in many cases, many examples of them, only exist for themselves, not for the shareholders. They don't care about the shareholders. In fact, the only use of the shareholder is providing liquidity, providing capital for the insiders, the executives, and the employees, until this whole shell game finally implodes. And for these companies that do try to take advantage of shareholders, things will inevitably implode. It happens every single time. The stock price drops very fast, the company does layoffs, investors lose a lot of money, and the executives walk away a lot richer at the expense of the shareholder. And I think as investors, we should try to do better to protect ourselves. I'm going to try to follow Michael Burry's advice better, looking at companies in a more cold, calculated way, always trying to protect myself as the investor and my interest in the company, and trying to identify companies that work on behalf of the shareholder, not on behalf of themselves. So that's all I have for this episode. I hope that this was informative. I hope you learned something from it. If you like this type of content, make sure to subscribe to the channel, hit the like button, and I'll see you in the next one.